effectively, the twin deficit worries are back to haunt the government, and this as they are in the last year ahead of the general elections 2019. So, as you're rightly pointing out, it is going to be a tightrope walk for the government as they manage the fisc, as they manage the macroeconomic headwinds, especially given the volatility that we've seen with the rupee as well as the crude prices. While crude prices have stabilized currently at about $70 per barrel, one has to take into account that this is at least 20% more than the kind of average that we saw in last year. And this is really what is really spurring the worry as far as the government's macroeconomic mathematics is concerned. In fact, if you look at the trade deficit, we are already at a 5-year high of close to $18 billion. And now fresh worries coming in on the current account deficit front. In fact, a lot of brokerages and economists are expecting how the current account deficit could be in the range of $75 billion, which is, of course, about 2.7 to 2.8% of the GDP. And now for the first time ever, the government conceding that the current account deficit could even slip a little above than what their expectation was. Remember, last year we saw current account deficit at about 1.5% of the GDP, and there was an expectation how this time around for FY19 it could be around 2.5%, and now the government is expecting a little more slippage. In fact, if you look at the way what the economic survey also said, that every time there is a $10 increase in crude prices, it leads to 9 to 8 billion-dollar impact on the government's current account deficit. So really it is going to be a tight rope walk for the government, and they have to find a way to manage their fisc better at a time like this.